A tender offer is not what you think it is. Most people hear the company is buying back shares and they file it under good news, liquidity, a win. But what if I told you the tender offer is one of the most precisely engineered tools on the cap table, and it's engineered for the company, not for you?
That's a strong open, Drew. Before we go in, this is an AI-generated conversation from AdValorem. 2 synthetic voices, education only. So, with that out of the way, what are we actually doing today?
We're pulling apart how private tender offers actually work. Because right now, every employee at every late-stage company is being told the tender is the exit. And almost nobody is reading the structure of the door they're being walked toward.
Okay, let's set the scene. You're an early employee at a company that's been private for 8 years. A tender offer gets announced.
And maybe it's a Tuesday morning. Maybe you're in line for coffee. Maybe you just got off a one-on-one where your manager said, "This is the moment." You feel relief. That's the dangerous part. Relief is the most expensive emotion on a cap table.
And the thing is, most people in that moment don't ask any of the right questions.
Right. They don't ask who set the price. They don't ask how big the window is. They don't ask which classes of stock are eligible. They don't ask why this tender right now. And they don't ask the most important question. They don't ask who decided you were allowed to sell at all.
Because in a private tender offer, and this is from Cooley's own published guidance, the company chooses everything: the buyer, the price, the eligibility, the amount each holder can tender, the disclosure package, every variable.
Every variable. The employee just gets a form. And the form looks like a stock sale, but it's actually a participation in a structured liquidity event the company has been engineering for 6 months.
Industries this happens in? Pretty much every late-stage one I can think of.
AI labs, defense tech, aerospace, logistics, climate, biotech, quantum hardware. Every company that stays private past year 5 eventually runs a tender. And every employee in every one of those companies thinks the tender is the same thing as an IPO. It isn't.
So if it isn't the IPO, what is it actually?
Let me say that again slowly. A tender offer is a tool the company uses to clean its cap table. The employee sale is the side effect, not the purpose. When you understand that, the whole structure rearranges itself.
Side effect. That's a shift.
Think about it from the CFO's seat. They have early employees with vested stock who want liquidity and who are starting to get loud about it. They have early investors with pro-rata rights that are getting expensive. They have a new lead investor who wants more ownership but doesn't want to dilute the founder. The tender solves all 3 problems with one document.
Wait, so the tender lets the new investor buy from old holders instead of from the company?
Exactly. The new investor gets ownership without dilution. The old holders get cash. The cap table gets cleaner. The founder gets thanked. And the price is set in a negotiation between the company and the new investor, with the employee as a passive observer.
So, when an employee looks at the tender price and thinks, "That's my company's valuation,"
That's not their company's valuation. That's the price 2 sophisticated parties agreed on to clear a specific volume of shares, usually at a meaningful discount to the most recent primary round. The headline valuation is a fundraising number. The tender price is a clearing number. They almost never match.
All right, so we've reframed it. Now, what does an operator actually do with this information?
4 steps. None of them are complicated. All of them are free. Number 1. Read the offer to purchase document, not the cover email. The company will send a 1-page summary. The real document is 40 pages and it's required to be filed. Read it.
Number 2.
Identify the buyer. Not the entity name on the form, the actual buyer? Is it the company itself, a new lead investor, an existing investor adding to their position, a third-party secondary fund? Each of those tells you a different story about what the company thinks is happening next.
3.
Compare the tender price to two anchors. Anchor 1 is the last primary round per share. That's the headline valuation. Anchor 2 is the 409A. That's the company's own internal valuation. If the tender is below the 409A, that is a signal. If it's well below the last round, that is a louder signal. Neither is automatically bad. Both deserve attention.
And 4?
Look at the eligibility math. How many shares can you actually tender? Tenders are almost always partial, pro rata across all participating holders. If the offer is up to 20% of vested holdings, you are not actually getting liquidity on 20%. You are getting it on whatever pro rata cut survives oversubscription. Plan around the math, not the headline.
Drew, quick parallel. This reminds me of something.
It should. Remember the question I opened with, who decided you were allowed to sell? Go back to the 1999.com IPO lockups. The story everyone tells is that early employees got rich on day one. The story almost nobody tells is what happened during the 180-day lockup. The smart money, the funds, the founders' family offices, the insiders who knew the structure, they ran private secondaries during the lockup window. They sold to each other at a discount before the public market ever got a vote.
And the employees?
The employees waited, then watched the lockup expire into a crashing market. They didn't survive. They spent the next 4 years explaining their tax bill. The tender offer is the modern version of the same door. The smart capital walks through it early. Everyone else gets handed a form on a Tuesday morning and thinks it's their idea.
This is the part where the playbook usually has someone trying to sell you something.
We're not. AdValorem publishes research on pre-IPO secondary markets, how tenders are structured, how they get priced, how the eligibility math actually plays out across the holders who participate. It's part of our broader education library. Free. Read it before you sign anything.
Where do people go?
Daily research at g-p.advalorem.io. The Discord. Link is discord.gg/g-ergtp9gts. That's where operators, founders, and allocators trade notes on exactly this kind of structure. The Substack at advalorem.substack.com if you want it delivered. And if you want to talk to someone, our community application is at tidycal.com/advalorem/syndicate.
And if someone's listening to this right now and they've got a tender offer document open in another tab,
don't be the one who heard it first and moved last. 40 pages, 2 anchors, the eligibility math. Read it before the deadline, not after. Position before you predict.
share this with one other allocator who needs to hear it. We'll be back Thursday.